Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. There's an adage, and it says that elections have consequences. The presidential election of November 2020 is over and done with. The runoff elections in Georgia for the two Senate seats, that also is completed, with the Democrats winning both of those runoff elections, giving them a very narrow majority in the Senate. How narrow? Well, the Senate is 50-50, and so the tiebreaker goes to Vice President Harris, meaning for all practical purposes, the Democrats have the majority, but you can't get any more narrow a majority. They also have a slim majority in the House. So elections have consequences. The Congress, with the Democrats in power of both chambers, can use special budget procedures to pass tax hikes. And I think it's fair, based on the platforms that most Democrats, including President Biden, have run on, would indicate a strong likelihood that we would see tax rates go up. What I'm talking about in terms of the special budget procedure is something called budget reconciliation. And by using budget reconciliation in the Senate, you do not need 60 votes to break the filibuster. It could be passed, legislation can be passed with a simple majority. Now, if you're opposed to the Democrats' view of legislating and governing, you may be upset by this, but there is a strong historical precedent for using budget reconciliation. So, a few historical examples. The tax hikes that were passed during the Bill Clinton administration in 1993 was done through budget reconciliation. Two tax cuts during George W. Bush's administration in 2001 and again in 2003 were also done through budget reconciliation. The Affordable Care Act, also known as Obamacare, that was passed by budget reconciliation back in 2010. And then most recently, the tax cuts that were passed in 2017 when President Trump took office was also done through budget reconciliation. So it's pretty normal for the Senate to operate this way. So I expect the Democrats will use this to their advantage and to fulfill at least some of their pledges that were made during the campaign season. It's a big question, I think an open question on what the Democrats will do with these majorities and how President Biden will ultimately govern. I think we could all agree that regardless of Republican or Democrat, there's lots of instances where things will be said on the campaign trail, things will be said during debates that may not materialize when you actually get in office. And that doesn't mean that they necessarily lie, although they do sometimes, but it might be difficult to get certain things passed. That is especially true with these narrow majorities. It might be difficult for the Democrats to keep their caucus together in all matters. There are times when a classic example is Senator Joe Manchin from West Virginia, a very Republican state, typically, but they continue to send Joe Manchin to Congress. But he needs to be careful about not being too extreme one way or the other and upsetting his base back at home in West Virginia. So it's not automatic that a caucus is going to stay together, and it may require a little bit of compromise, not only between Democrats and Republicans, but also between the Democratic caucus to keep them together, or some compromising and negotiating to try and peel off some Republicans to get them to vote for certain initiatives and legislation. So what will the Democrats do? I think, as an example, I'll throw out a few things that I think are likely. I believe that the top tax rate is likely to go back to 39.6%, which is where it was before the President Trump tax cuts occurred in 2017. I think we're likely to see corporate tax rates go from 21% to 28%. Let's put that in perspective. It was 35% for a generation. Then with the tax cuts in 2017, that dropped down to 21%, with the thesis that a lower corporate tax rate, such as 21%, would be more in line with the corporate tax rates around the world, making U.S. corporations, putting them on more of a level playing field throughout the world. I think the Biden administration and the Democrats would like to increase that. I would anticipate that getting back to 35%, which might be desired in some circles within the Democratic Party, I believe that the compromise is likely to be at the 28% level. I want to also point out that for individuals who do not want to see tax rates go up, who believe that's generally bad policy, and I would generally fall into that camp. I think it's anti-growth, and given that we're dealing with the with the pandemic, and we're dealing with the economic after effects of the closures and restrictions we've had to do since March of 2020, I don't think it's necessarily a great idea to raise taxes. But to be fair, these rates perhaps going up is not an automatic trigger for a recession. We've had these rates before, and the U.S. economy has flourished. So I do not believe that this kind of thing, although personally, if President Biden asked me, I would propose these increases not take effect, certainly not this year in 2021. But I also do not believe it means that the sky is falling. Another provision is the SALT. So in the legislation in 2017, there were limits put in place for your ability to deduct on your federal tax return your state and local taxes, including property taxes. And so that essentially was a tax increase for usually wealthy individuals, because you need a pretty big state income tax bill or a pretty big property tax bill. But it's very unpopular with the Democratic Party. It affects some states way more than others. I am a resident of Connecticut, and it affects us greatly here in Connecticut. New York, California, Illinois are other states that are impacted greatly by this, and those tend to be reliably voting Democratic states. So I think SALT is likely to change, but I would guess that they would take the limit from 10 to 20,000, which would give ample room for lots of people to get some tax relief. I know for myself that would be an improvement on my personal taxes. Again, being in Connecticut, it's a high tax, high cost of living state. So going from 10 to 20 would actually be good for my pocketbook. Policy-wise, I think it should stay at 10, but I don't think it'll go away completely. My guess is they would look to move it to 20,000. Next, I wanted to touch on the estate tax exemption. So if you pass away in 2020 and your estate is $11.6 million or less, there's no estate tax. Now, this estate tax exemption, over the course of my 29 years as a financial advisor and certified financial planner, I mean, that number has bounced all around. I remember it as low as 1 million. It was 5 million at one point. It was 10 million. It's historically high now at 11.6 million. I believe the Democrats will like to lower that. My guess would be a compromise would be in the $6 to $7 million range. That still means that the vast majority of households would not be looking at a federal estate tax bill, but it would catch enough wealthy individuals such that it would raise tax revenue and would accomplish the mission of the Democrats, where they want to have tax fairness and they want to get more tax revenue from the wealthy in the country. Let's talk a little bit about capital gains tax rates. It's been 20% for a long time. The Democrats would like to increase that. I know one of President Biden's positions on the campaign trail was for the highest income earners in the United States to take the capital gains rate all the way up to 39.6%. He might want to do that. He might not. But either way, I think that might be a bridge too far. But I believe if I was a betting man that they would look to move the capital gains rate from 20 to 24. As Brian Westbury pointed out, he's an economist with First Trust. He pointed out that if you go to 24 and then you add in the Medicare surcharge, which is 3.6%, that's a surcharge or an extra tax that is only imposed on the highest income earners in the United States. If you do that, 24 plus the 3.6%, you end up at about 28%, which is the rate that the capital gains was at when President Ronald Reagan left office back in 1988. And Brian Westbury's point, and I think it's an excellent one, that would provide wonderful optics for, hey, we're raising the capital gains rate, but don't be overly alarmed. It's the same rate we had under the Reagan administration. That seems to be a pretty good selling point. Now, that might be marketing, that might be spin, but I bet that's pretty effective too. I like it at 20, but I have a feeling it's going to go to 24. Again, I do not believe that that would be an automatic trigger for recession. It might be anti-growth, but it does not mean that the sky is going to fall. I'm recording this in early 2021. We're still not entirely sure how President Biden is going to govern. There's still a lot to play out. We have to get further beyond or further into the vaccine rollout, get the country on a more normalized footing with the healthcare crisis and the corresponding economic shutdowns. I do not think that the Biden administration will try and do sweeping tax reform, read that as tax increases, in 2021. I think they will have their hands full in other areas. But elections certainly have consequences. I've spoken with a lot of clients that are very concerned about increased tax rates. They're worried a little bit about their own pocketbooks, but I think a bigger issue is their concerns on what that would do to the economy and the markets. And I think that their worst fears will not be realized, but it is an area of concern because the economy, although trending in the right direction, has certainly been weakened by everything that's happened since the pandemic emerged on us last year. So elections have consequences. We will have to see how that plays out. One thing I wanted to just say in closing is that for the vast majority of my career, and well, let me say it this way. At the beginning of my career, when I was young and learning the business world, I was taught that you didn't want to talk about politics and you didn't want to talk about religion in polite company. And in the business world with clients, you did not want to speak about such things. I adhered to that, and that made complete sense up until, I believe, the 2008 timeframe when we had the Great Recession. It seems to me that there was a significant shift at that time where it is now extremely difficult to talk about investments, financial planning, expected returns, do retirement analysis to forecast how someone's retirement will look like if you don't talk about what's happening in Washington, D.C. There is so much that goes through the political realm before we could really talk about investments and returns and asset allocation and portfolio construction. I just don't think there's any way around it. I try and be very careful when I speak with clients. I share my opinions politically. I'm not shy about that. But I also believe that I'm reasonable and balanced and try and remain unemotional when dealing with money issues and buy-sell investment decisions. And I think here at Elliott Wealth Management Services, as a team, we're very, very good at that. I recently did an episode with Dean Nicholson, who's a retired advisor and an economist, and he talks about this all the time. But the political discussion that I have with clients is important because the work that politicians do, the impact they have on our everyday lives, personally, as well as the business climate, is incredibly important. And they can swing things very significantly with what they talk about and what they do. So I think that the old lesson about not talking about politics is very difficult for a financial planner. So I do it. I have found over the years, because this is, if we started talking more about it in 2008, That's 13 years ago, which in and of itself is crazy how long ago that period was. But clients appreciate our approach to this because we're not throwing hand grenades. We're smart about it. We look at historical precedent. We take a balanced view on things. We're not alarmist. We're very realistic. We'll call it as we see it. And I found that clients are very appreciative of those constructive discussions, even though sometimes they could be a little sensitive, especially in situations when our worldviews do not necessarily match up. But we stay respectful, listen to one another, hear each other out, and then we try and make good, fundamental decisions that'll help our clients achieve their financial goals and objectives. So thank you so much for listening. I appreciate it. If you haven't subscribed to this podcast, please do so. Recommend it to a friend, coworker, family member. That would be wonderful. I will be back with you on the next episode of the Simply Financial podcast very soon. Again, thanks for listening.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.